So last week I attended Adam Khoo's Investment Outlook event and even had the opportunity to have lunch with him. During lunch, I asked him one question that had been on my mind and his advice totally caught me off guard. It wasn't what I expect at all. After that conversation, I went straight home and reallocated my entire investment strategy for the year. His insights didn't just surprise me, they completely shifted the way I think about investing this year. In this video, I'll share my takeaways from the event. Part 1, the 3 biggest lessons from 2024 that we must carry into 2025 if we want to be on path to massive profits. Part 2, the 5 market catalysts that will drive 2025. Part 3, the personal advice I got from our lunch conversation that completely changed how I approach investing this year. If you're investing in 2025, what I learned during the event might just change how you approach your portfolio too, so stick around to find out. And if you're enjoying content like this, hit like and subscribe. It helps support the channel and ensures that you won't miss any future insights. Let's start with the biggest takeaways from 2024. 3 lessons that could set you up for success in 2025. Lesson number 1, never listen to predictions of economists and analysts. In 2024, headlines were filled with dramatic predictions of the stock market crash, fueled by stories like China Evergrande collapse, fear of Middle East war grows after Hamas leaders killing, Japan's stock market crash biggest since 1987, and the US national debt tops 35 trillion for the first time. But here's the reality. Despite all the fear, uncertainty and doom, the S&P 500 gained 29.95%, the Nasdaq surged 26%, and even Singapore STI rose by 16% after being stagnant for 10 years. The lesson here is simple. The market climbs a wall of worry. And this isn't just a one-off story for 2024. For the past 50 years, every year has brought new fears. Every year there's always something to fear. Every year there's always someone claiming the next big crash is around the corner, yet the market keeps proving these predictions wrong. Why? Because headlines exist to grab attention, not to make you a better investor. Sensational story drives clicks and views, but they don't drive returns for your portfolio. And here's the truth, fear sells. And while fear dominates the headlines, it often creates opportunities in the market. Savvy investors know how to use this and use it to their advantage. Remember, the market rewards patience, not panic. And I'll be honest, there have been times I've let fears or headline influence my decisions, but 2024 reinforced something I already knew. The people who stay calm, focus on the fundamentals and ride the storms are the ones who win in the long term. In 2025, my approach will be clear. I'm tuning out the noise, I'm focusing on the data, the fundamentals and the bigger picture, because history has shown us the prophets of dooms are rarely right, but the patient investors always win. Lesson 2, invest only in high quality and predictable stocks. Don't get tempted by cheaper, lower quality, unpredictable stocks. Adam Khoo opened with a question that made everyone in the room stop and reflect. How many of you have ever bought a stock that seemed like a bargain because it looked cheap but wasn't high quality? Almost all of our hands went up, including mine. Okay. And then he asked, how many of you have bought a stock that dropped more than the others, thinking it will recover more, or chose a stock because it went up less, believing it has more potential to run? Again, almost every hand was raised. At that moment, Adam said something that stuck with me. That's the biggest mistake you can make as an investor. In 2023 and 2024, we saw this mistake play out in real time. In 2023, Nvidia was up an incredible 233%, AMD climbed 130%, and Intel gained 87%. At first glance, you might think, okay, AMD and Intel seem like great bargains. They have shown strong performance and have room to grow. But that's where most investors make their first mistake. Looking at past performance without understanding the company fundamentals. When you dig deeper into the financials, Nvidia stands out for a reason. Quarter after quarter, Nvidia delivered consistent revenue growth, rising net income, and strong free cash flow. AMD's growth was inconsistent and Intel struggled with declining revenues and negative cash flow in several quarters. Fast forward to 2024 and the result speaks volume. Nvidia gained another 173% while AMD dropped minus 13% and Intel plummeted 59%. The market rewarded Nvidia for its financial strength and leadership in the AI revolution, while AMD and Intel just couldn't keep up due to the weaker fundamentals. This example completely reshaped about how I think about investing. It's not about finding the cheapest stock or the one that looks like it's gonna have the most room to recover. It's about identifying companies with the strength to thrive regardless of market conditions. Nvidia wasn't just hype, it earns its returns through superior results. Adam's lessons was clear. The market rewards quality, and this doesn't just apply to tech stocks. It's across every sector. High quality businesses with strong fundamentals consistently outperform those that appear to be bargains but lack financial resilience. As Warren Buffett famously said, it is better to buy a wonderful company at a fair price than a fair company at a wonderful price. That's the mindset I'm carrying into 2025. Lesson 3, portfolio diversification is critical to success. Let your winners run, keep your losers small. Let's start with a staggering fact. Berkshire Hathaway has outperformed the S&P 500 by 43 times, achieving a 170,000 return as compared to S&P 500 3,900% return during the same period. How did Warren Buffett achieve this? The answer might surprise you. It wasn't by being right all the time. In fact, Buffett admits himself that only 5% of his stocks he owned contributed to 90% of his gains. Only about 5% of the stocks contributed to 90% of his gains. Isn't that crazy? Adam Khoo emphasized a lesson during his event that was often overlooked. Diversification is critical, but letting your winners run is what creates exponential growth. Here's how he explained it. Imagine a portfolio has 10 stocks. Even if 3 of them goes to 0 and the other 7, if they deliver a 2 times, 5 times or even 10 times return, they can give you and drive you a double-digit annual return for your entire portfolio. That's the power of smart diversification combined with letting your winners do the heavy lifting. It's the same principle Buffett applies. He openly admits that over decades of managing Berkshire Hathaway, only a dozen truly great decisions drove the bulk of his returns. Think about this, out of hundreds of investments, just a handful made the difference. We've seen this play out in recent years. Take Nvidia and Palantir as examples. Nvidia soared 233% in 2023 and another 173% in 2024 because of his leadership in the AI space. Palantir, another AI-driven company, has delivered exponential growth. These are the kind of winners that can carry an entire portfolio. Meanwhile, while other investments might lag, but that's okay because your winners make up for the losers. The hardest part though, having the discipline to hold on to your winners. It's tempting to sell a stock after it doubles or even triples, thinking that you have locked in enough profit. But as Buffett and Adam both teach, this short-term mindset can rob you of massive gains that only come with time. So for 2025, my focus is clear. I'm thinking of my portfolio as a whole like a fund rather than obsessing over the short-term performance of individual stocks. Diversify smartly, let winners run, and embrace the idea that not every stock needs to be a home run. As long as your portfolio is positioned to capture those rare transformative opportunities, you're on the right track. So the biggest question on every investor's mind is, where will the stock market be in 2025? Adam emphasizes that while we can analyze trends and make educated predictions based on probabilities, the real focus should always be on long-term investment principles, not short-term speculations, because nobody can predict the market. Adam began with the technicals. Over the last 74 years, the S&P 500 has made annual gains 78% of the time. What that means is if you invest in S&P on January and you have a 1-year time horizon, your probability of making gains is 78%. Pretty good odds. However, after 2 consecutive years of gains above 20% in 2023 and 2024, could the S&P 500 deliver a third year of gains? We're doomed for the market to drop, right? Well, let's look at the facts. Since 1951, there has been 5 such instances, and in 4 of those, the market delivered a positive third year. This historical data suggests that 2 strong years doesn't necessarily mean that the market is due for a correction. 2025 also happens to be the third year of this bull market that started in November 2022. The average bull market lasts for 5.5 years, and the third year of the bull market has been positive 75% of the time, with median returns of 9.7% and an average return of 7.8%. But historical technical patterns alone aren't enough to predict the future. Do the fundamentals justify the market to continue going up? That's the real question. Adam laid out 5 specific fundamental factors driving his optimism for 2025. Catalyst number 1, the S&P 500 earnings growth project to grow 14.8% in 2025, above the trailing 10-year average of 8%. Why? Because of the increase in productivity and profit margins. All 11 sectors are expected to report a year-on-year earnings growth in 2025. 6 of these sectors are projected to report double-digit growth. IT, healthcare, industrials, materials, communication service, and consumer discretionary. And the Magnificent 7 companies are projected to report growth of 21% in 2025. Other 439 companies to report earnings growth of 13% for 2025. Profit margins in 2024 accelerated from 2023 because of artificial intelligence being deployed by companies. The estimated net profit margins for the S&P 500 is expected to hit 13% in 2025, which is above the 10-year average of 10.8%. With high profit margins and higher earnings, there will be high probability for further gains. Catalyst number 2, the 6th wave of innovation, the AI revolution. During 2004 to 2024, the S&P 500 delivered an annualized return of 10.75%. Fast forward to 2014 to 2024, that number jumps to 13.34%. But here's where it gets even more fascinating. From 2019 to 2024, the annualized returns skyrockets to 16.01%. The market is growing faster and faster, but why? It all boils down to one game-changing factor: technology. Tech and AI has transformed the ways companies operate, allowing them to grow earnings faster than ever before. In the past, it might have taken a company 8 employees to generate $1 million in revenue. Today, with technology, the same company might only need 2 employees. This isn't just an incremental improvement, it's exponential. And now with generative AI, robotics, quantum computing, when it becomes mainstream, companies will slash costs, drive productivity, and boost profit margins at scale that we've never seen before. So here's an example from Accenture. AI has the potential to increase corporate profitability in 16 industries by an average of 38% by 2035. This isn't just speculation, it's already happening. This is what Adam Khoo refers to as the 6th wave of innovation. As Sundar Pichai, the CEO of Alphabet, put it, artificial intelligence will have a more profound impact on humanity than fire, electricity, and the internet. Let that sink in for a moment. Imagine a company in the 1900s refusing to use electricity while its competitors powered their factories. That's the kind of transformation AI is bringing. Companies that embrace this wave are setting themselves up for massive gains, while those that are resist risk being left in the dark. So if you're wondering why the market is accelerating, the answer is clear. Technology and AI are driving a new era of earnings growth and market expansion. The sixth wave of innovation is here and it's creating opportunities we haven't seen in decades. Catalyst number 3, Trump deregulation and tax cuts. Love him or hate him, Trump has historically been one of the most pro-stock market presidents, often using the stock market as a measure of his success. If you are an US stock market investors, he's essentially your greatest cheerleader. In his first term in 2017, Trump reduced corporate tax from 35% to 21%, which significantly boosts corporate earnings. Now he's promising to lower corporate tax even further to 15%, potentially increasing after-tax earning by 4 to 5%, which could drive stock prices even higher. Trump has also pledged widespread deregulation across key sectors like finance, healthcare, and biotech, which reduces compliance costs and gives businesses greater operational freedom to improve profitability. Finally, his proposed fiscal policies include tax incentives for business owners and homeowners, which could stimulate economic activity and further support market growth. While these policies are not without controversy, their potential impact on corporate earnings and stock valuations cannot be overlooked. Catalyst 4, increasing global liquidity. In 2022, global liquidity dropped by 40% in just 1 year because central banks tightened monetary policies. Central banks control money supply primarily through interest rates and bond purchases. Hold on, I know I'm gonna lose here, but I promise you I'll simplify it. Basically, central banks like Federal Reserve, the European Central Bank, and the People's Bank of China control how much money there is in the economy. They can add more money in by lowering interest rates and buying things like government bonds, or they can take out money by raising interest rates. In 2022, they take out a lot of money to fight inflation, but companies kept making more money, so the stock market went up anyways. Now the banks are adding money back into the economy to help it grow again. This extra money makes it easier for people and businesses to spend and invest, which can help stocks to go up even more. Combine that with the ongoing AI revolution, this increased liquidity will likely provide even more support for the stock prices, creating a favorable environment for investors. Catalyst 5, $7 trillion in money market funds ready to flow. Right now, there's $7 trillion parked in money market funds, which are your fixed deposits, your high interest savings account, and whatnot. Many investors chose to park their money there for the past 2 years because they offered a safe 4%, 5% return, but they missed out on 2 years of stock market gains of over 20% annually. So as interest rates starts to drop, the market for money market funds, fixed deposits, or savings account will become less and less attractive. When that happens, investors are likely to move their money out of these funds into higher return assets like stocks, which is exactly what's happening now in Singapore. Fixed deposit in 2024 have dropped from 4% to slightly under 3% in 2025. When that happens, investors are likely to move their money out of these instruments into higher return assets like stocks. Even if just a fraction of this $7 trillion flow in the stock market, it will create a massive surge in demand, pushing stock prices higher. After the seminar, I had the opportunity to have lunch with Adam Khoo, and I asked him a very specific question. Adam, if you were under 30, how would you invest your money? His answer completely caught me off guard.
I can take more volatility because I got a longer runway. Then, yeah, I guess I'll focus more on the high growth stock. Yeah, mainly it will be tech lah. 80%. You 100%. You young 100%.
100% to growth stocks into the tech sector, especially in this AI-driven sixth wave of innovation. Don't even bother diversifying. So at first I was confused, like how could this align with what you said during the seminar about diversification being critical? But as Adam explained, it all depends on your stage of life. Diversification is critical for those with a shorter time horizon or lower risk tolerance. It protects your wealth and helps manage volatility. But for someone like me at 27 who wants to become massively wealthy, with decades ahead to recover from the stock market swings, this is the time to focus on building wealth rather than to protect it. Concentration, he said, is a strategy for those who want to capitalize on transformative opportunities like the current AI revolution. And this advice doesn't contradict with the lessons from the seminar. It complements them. At the portfolio level, even when you're concentrated in one sector like tech, the principles of diversification still applies. You can still spread your bets across multiple high-quality tech companies while remaining focused on the sector driving the most growth. And in fact, companies like Google or Amazon are already very diversified within themselves. You can compare it to the early days of Apple or Microsoft. Back then, you wouldn't have diversified into Coca-Cola or healthcare. If you wanted to build a lot of wealth, you would have taken concentrated bets on the companies defining the future. That's the opportunity we have today with AI. Diversification, he explained, is about protecting wealth. Concentration, when done wisely, is about creating it. After that conversation, I went home and reallocated a majority portion of my portfolio into high growth tech companies. I also kept the principles of smart diversification in mind, spreading my investments across multiple leaders within the sectors. This way, I'm positioned for exponential growth without taking on unnecessary risk. Adam's insight reminded me that investing isn't a one-size-fits-all kind of thing. For someone in their 50s, diversification and stability might be the priority. But for someone like me, this is the time to embrace volatility, align with the industries that shape the future, and let time be my greatest ally in building wealth. So once again, this is what I'm doing for myself. This is not investment advice. You have to find something that works for you. If there's one thing to take away from this video, it's that 2025 is all about the sixth wave of innovation. The AI revolution and strong earnings growth are creating incredible opportunities. Focus on high quality companies with long-term potential and be bold enough to capitalize on them. So what about you? Would you go all in on tech and AI, or are you seeking to a diversified approach? Let me know in the comments. I'd love to hear your thoughts. Alright, if you found this video insightful, don't forget to like, subscribe and share with others who are navigating their own investing journey in 2025. Thank you for watching and I'll see you on the next one.